Welcome, everybody. It's John Pocoroba, and it's July 4th, 2022. Just wanted to wish everybody a happy Independence Day. Great time for a market update. Hope everybody's enjoying the weekend. I know I am, and it's also coincides with my birthday tomorrow. So let's talk about the markets. So as a reminder, I'm an amateur investor not affiliated with IBD or MarketSmith, and the presentation is made by Rain King LLC. So the agenda is the current market briefly, talk about bear markets, and most of our time will be talking about market bottoms and things to look for. Long-term support levels, I've covered these before. Basically, a zone between 10,000 and 11,000 would be still within the norms for the super cycle to continue. The current market right now is, we had a follow-through day, number 5. We had distribution soon after the follow-through day. And technically, the follow-through day is still operative. You have to undercut the lows of the rally to officially have that follow-through be dead. So it's still alive. But what's noteworthy is the rallies, each time we've had a rally, has been getting smaller. The market is very, very weak, particularly the NASDAQ is very, very weak. Psychological numbers, we've talked about the 10,000 level as possibly being a round number bottom in that vicinity for the NASDAQ. And incidentally, you know, it was actually a psychological market top for the markets back in 2020. So there's been rotation in the past couple of weeks. You know, you've probably noticed that the cyclicals and the commodity stocks and groups have been breaking down since early June pretty sharply. And you'll notice that if you follow the defensive sectors, the consumer staples, utilities, and healthcare, which I have labeled on this chart, you can see that they have been increasing in relative strength. That is really typical for late in a market cycle. It really is kind of the last sectors that will be a safe haven for institutions in a market downturn. So the market is still discounting an economic slowdown in a possible recession. I put this tweet in here because this is the Atlanta Fed, and they've been actually adjusting their GDP numbers down. If these numbers were to happen, you basically get another quarter of negative growth. Last quarter had negative growth, and 2 quarters of consecutive negative growth is the definition of a recession. So keep that in mind. Defensive sectors are where people are putting money at the moment. So bear markets. I've covered this before, but I'll do it briefly again. When bear markets, I use the S&P for my data. And when the data for an S&P decline reaches the 25% level, that triggers to me really what I call a major bear market. And the S&P has come down. The low was 24.5% in 178 days. So we're really there. So when that happens, my expectations change, and I use different indicators to understand the market. There's been 6 of these major bear markets in 71. The average loss is almost 40%, and it's taken over 500 days to get to the eventual low in that bear market. And it's important to know that, you know, bear markets are measured in months and years, not days and weeks. And they typically, the S&P has averaged 7 failed follow-through days. We have currently had 4 failed follow-through days, and we're working on the 5th follow-through day. We always have to respect the market, and we also have to be aware of recency bias. The last 2 bear markets we had were very brief, and they were very sharp V recoveries. The 2018 bear market was only 3 months. The 2020 was only 1 month. So sometimes you get your mindset in a place where you think this one is going to reverse quickly. This one seems to be different. Time will tell. But inflation, you know, inflation is a very dangerous disease, not seen since the 70s. So if you didn't live through it or see it, it's hard to appreciate it. But, you know, the Fed has to come up with a cure for the disease. And then you say to yourself, what's the effect of the cure going to be on economic growth? Many people really underestimate inflation as an opponent. I use the analogy of, Mike Tyson was a very tough opponent. You may be able to knock Mike Tyson down to one knee during a fight, but it was very difficult to knock Mike Tyson out. Inflation is a very difficult opponent. So major bear markets, again, off 25% or more, they really, over history, if you study this, they end in two ways. Type A is when you have capitulation selling, which is very high volume selling, and usually a wide range and a reversal. Or you have type B, which are bear markets that grind down. They're very extended downtrends that selling eventually dries up. So if we look at the six major markets in history since 71, how did they bottom? I shared this before. Most of them have bottomed. 4 out of the 6 were a type B, an extended downtrend, grinding lower and lower. We'll have to see how this one plays out. We're technically about 6 months into this bear market, so it's actually relatively young compared to some of the averages. As you can see on the screen, the average is over 500 days. So I've included the recession component. This data is from Chicago Capital, and it actually captures the largest S&P drawdown since 1950. And I've added a column to the right, which actually are these drawdowns relative to if there was a recession. And those recessions are highlighted in this column in yellow. You'll notice that the top 3 biggest drawdowns in history actually coincided with recessions. All 6 had a recession for these deeper drawdowns when you get below a 25% decline. In the market this week, I think there was definitely some indication that the odds of a recession have really increased, which could suggest maybe there's more downside in a possible third leg down coming in this bear market. The Fed seems to be on a month-to-month read of the data, particularly the CPI and the PPI. That month-to-month approach, in my opinion, does not really instill a lot of confidence. It creates uncertainty and volatility in the markets that's still present. We're also in the summer doldrums, which is a very lower amount of volume occurring in the market, and so you can get a lot of volatility. It's not a time when all the market participants are engaged. So let's get into market bottoms and specifically share some things to look for. So this is a slide that I showed in March 10th on my video update. I'm not going to go over this line by line, but you might want to pause your video player because these are the things that I had noted, but it wasn't really appropriate to go deep into these things at that time. But I think right now where we are in the market is a much more appropriate time to look at specific things to look for in market bottoms. So we're going to get into this in some detail today. So I'm going to share with you my favorite indicators looking at market bottoms. I think I've tweeted that the fewer indicators you use, the better, but really trust the ones that you keep that have proven successful and they're reliable to you. There are lots of indicators, and you should use the ones that you feel comfortable with, that have served you well. So I'm not saying that these indicators are perfect. I'm not saying that they're the best ones that you should use them, but they have served me well over the years. So I thought I would share them and the simplicity that I try to keep around looking at the market relative to these particular market bottoms. So we'll go through the follow-through day concept, new highs, new lows. I'm going to show you a 5-day breadth thrust indicator. I'll throw in 3 sentiment indicators, which are all secondary and tertiary. Probably the most important is price and volume of the stocks themselves. So we'll go through these one by one. And these are not in any particular order. But what's important is, to me, is you got to get at least 2 to 3 or 4 of these indicators all pointing in the same direction to really give you some confidence that maybe things are coming together for a bottom. So the first is the follow-through day concept. Most of you are probably very familiar with this concept if you follow William O'Neill, but I'll quickly review it. The concept is the market makes a new low, And once the market starts to rally, you'll get the market index will close higher for the day. That becomes day one of a rally attempt. I'm kind of showing you the 2003 bottom here. And then what you're looking for is a follow through day, which is defined as the index closes up a minimum percentage on higher volume than the previous day. And it has to be day 4 or later. And the volume doesn't need to be above average. It just needs to be higher than the previous day. So typically 1.25% is a number that you would use. But when you have deeper bear markets that have a lot of resistance to overcome, I will increase that. I really want to see 2-3% on a follow through day. So it's very, very convincing and obvious that institutions are behind the move, and it's not just short covering and short-term buying. In the current environment, I would look for a minimum of, this is a minimum of 1.7% for me to really take it seriously when you're this far down in the decline that we've seen in the market. You can have something called a pink rally day, which I've shown on the right here. This is October 2014. A pink rally day is the index makes a new low and you close in the upper half of the range. You are down for the day. So it's a pink bar on MarketSmith's charts, but you can count that as day one when you have a pink rally day, when you're counting the days to get to a follow through day. So you're probably familiar with this concept. Now you'll notice that sometimes when I tweet things out around follow through days, you'll notice that I tag all the leading symbols that came out of that particular market low. And I keep a database because I want to know where the leadership came from. And it's important that over time, bull market leadership comes out in the first 13 weeks after a follow through day. So all those bottoms that I show in my tweets, you'll notice I had the shaded zones of weeks 1 through 4 and weeks 9 through 13. And then this happens to be the 2020 bottom, and as of June 23rd, these are the symbols and when they actually broke out, and I color code them by what sector. Were they big caps? Were they IPOs, technology stocks, biotechs? It's a good way to keep an inventory of past history of bottoms and where the leadership comes from. And also you have leaders that sometimes appear before the follow through day breaks out. So here is the December 2018 bottom. And again, you can see my chart in yellow is weeks 1 through 4 after a follow through day, and the blue is 5 through 13. And a couple of key concepts here. One is, you'll notice that when you get a really successful follow through day, this happened on January 4th, day 7. Usually the most successful follow through days, powerful ones, are on day 4 through 10. But they can come then, day 15, day 20, but they're a little slower starting. But you'll see here that I've marked, look at all the subsequent powerful days in the market, up 1%, up 1.3%, up another 2.2%. It's this consistent buying that gives you confidence that that follow through day is going to work. And you'll notice that many of these in the 2018 bottom happened in the first 4, 5, 6 weeks off the bottom. You were having stocks break out, and you were getting subsequent follow through days to showing you that this is a real rally. So it's important. Now here's some interesting data. You might want to pause your video player. This is actually some studies that we've done over the past. I know Ehrman has done some studies for the 2010 to 2012 rally, and these columns represent when the big leaders broke out, either before the follow through day, weeks 1 through 4 post follow through day, weeks 5 through 13, or weeks 14 or longer. So in Ehrman's data, you can see 28% broke out before the follow through day. The 2 rally studies that I've done are 2012 to 15, 2016 to 18. And you can see the statistics, 22% broke out before the follow through day in 2012. In the 2016 rally, it was only 9% before the follow through day. So it's an interesting tidbit to see where the leaders, they come out in the first, 13 weeks generally. You'll get generally over 70% of them typically. So the next indicator that I use is really breadth. And what I use is new highs and new lows. So this is actually a chart showing new highs minus new lows. So you get a net number. And the way I use it is pretty simple. I really look at, if I have the index here in the top window, I'm looking at when the index makes a new low, what does the net new high, new low show? So you'll notice here that in March, the low came in, we had very, very high net lows. And you can see every new low I'm looking at are the net new lows getting higher or lower, because I'm looking for a divergence. I want to see the index hit a low and maybe the net new lows do not, they start to dry up. You'll notice here in the last month, the new lows have been drying up, the net new lows, but then I also cross-checked that by looking at actual new highs in the NASDAQ. So in this case, even though the net new lows were drying, I want to know that the actual issues in the NASDAQ are advancing. So in this case, we're seeing the new highs are not increasing. So that's telling me there's a pause maybe in new lows and we're going sideways. We're not seeing a thrust of stocks starting to make new highs yet. So it's just a cross-check, pretty simple, but it's using this to look for divergences. And I use this it's pretty reliable at market tops and market bottoms. But again, it needs to be used in conjunction with other indicators. So a 5-day breadth thrust. Let me talk about this a little bit. There's a really good 2009 research paper called Planes, Trains, and Automobiles by Wayne Whitley. And I've tried to give you a site here. It's actually lindarashke.net. You can put this in your browser and you can get a hold of this research paper as a PDF. So that's a place to try to get the information, which goes into great detail in the research behind its statistical analysis. The other good paper is 2002 from Lowry Reports. It's a paper called Identifying Bear Market Bottoms and New Bull Markets by Paul Desmond. So I put the link there, the websites. You should check those out. You can download the report. The reason I'm using this now is because when you're in a major bear market and the S&P is off a 25% minimum, it's appropriate to use what I think is a 5-day breadth thrust. I know there's other breadth thrusts out there, back-to-back 90% days or 2 or 3 80% up days. Those are good, I think, between 8 to 12%, 8 to 15% intermediate corrections. But when you're off 25%, you need more, in my opinion. These particular signals I'm going to show you do not signal very often at all. Sometimes there's years between signals. Sometimes it could be 5 to 10 years between signals. But the concept is, just like a rocket needs a significant amount of thrust to break through the Earth's atmosphere, when you're in a deeper bear market, the initial rally needs enough thrust to get through all these levels of overhead supply, overhead resistance, failed, basically former failed launches, rallies that have failed, follow-through days that failed. It takes a lot of buying pressure to get through all those levels. And that's why when we get below 25%, I want to see a 5-day thrust. So I'm not going to go into huge detail because we just don't have time for it, but I do recommend you read the paper, but I will give you the highlights. So the highlights, there's 3 measures as part of a Whaley breadth thrust, and you can have any of these trigger. The first is advancing issues and declining issues on the New York Stock Exchange. And I just go to wallstreetjournal.com and you'll see they have something called the Markets Diary, and it'll show you the issues that traded that day, how many advanced, how many issues declined. So keep that in mind. The second part of the thrust to look at is look for up volume and down volume on the NYSE. That's also captured here. Here's the advancing volume, the up volume, the down volume, and the total volume on the NYSE. And the third is looking for a price thrust on the S&P 500 over a 5-day period. So I'll give you the highlights, but I encourage you to read the paper, or maybe I'll do a future video getting into this in great more detail because I could spend 20 minutes just on using this. But essentially, the study is about doing a 5-day thrust and it looks at the S&P's performance over the next 12 months, and they're very strong returns. So the advanced decline thrust, called the ADT, is a 5-day running total of the advancing issues divided by the total issues trading. And it's a 5-day total. And the signal is really when you get extreme low levels below 19% or above 73%, those are meaningful signals. Very similar on the up-down volume thrust. On the NYSE, it's a 5-day running total of up volume divided by the total volume on the NYSE. And you're looking for a 5-day, there are extreme low number of below 16% or above 77.8% are meaningful signals. And the third is the S&P price thrust. Over a 5-day period, you really want to see the S&P make over a 10% gain over a 10%, or excuse me, over a 5-day running total, or a complete dry up, which is actually below 13%. And like I said, these don't signal very often. It could be years. And so the data in the paper goes from 1970 to 2009, and there are only 12 times it signaled. I flagged what I wanted to show you was it's pretty noteworthy that 5 of the signals over the period of time, 1974, 1982, 1987, 2002, 2008, these are major bear markets. And then these signals triggered, they were very helpful in understanding the forward returns for the S&P. So I've only given you an appetizer here, but I encourage you to download the PDF paper, which has all the research, and anybody can use this if you want to track it. So number 4 is some sentiment indicators. And again, these are secondary. You would never trade off these, but they give you a sense of what's going on with the crowd thinking. The VIX. This is a longer term, multi-year chart of the VIX. And it's really simple. You want to see when the VIX spikes, it's a good indication of fear in the market, and people are buying essentially insurance. They're buying protection because they're fearful. And it's really simple. Usually at market bottoms, you see the VIX spike pretty high. Generally, VIX spikes over 40, which are pretty extreme, is a pretty indication. So I generally look at it very simplistically. Did it get to some of these higher levels? You'll notice that even though we've had a trend higher, we haven't gotten a real panic type of VIX spike yet. The second one is the put-call ratio. I use the total equity put-call ratio, and simply using the put-call ratio being above 1 indicates extreme fear, and it usually shows up at market bottoms. So I've marked here some of those spikes. This was the December 18 market low. You can see the spike. There was a spike here in October. This is the 2020 COVID crash. And you'll notice that we haven't gotten to that level yet in the current market, in this bear market. So pretty simplistic, but you're looking for real outliers to help you with understanding the crowd and how protective they are about buying puts. The third one is the AAII survey. And this happens to be a view of it looking at the net bulls minus bears. So take all the people out in the retail crowd that are bearish and the ones that are bullish and getting a net number. This indicator has been very extreme for a while. And you'll say, geez, you'd never trade off this, because even though it was extreme here, well, it got more extreme here. And actually it's record extremes here, and the market hasn't turned yet. So even though these can reach extreme levels, that's why they're secondary and they're tertiary things that you want to see combined with some of the other indicators that we're showing you today, to say if these things all start to cluster as indicators, then you might have something really starting to materialize. So the fifth, and probably the most important of the entire list, is the price and volume of stocks themselves. So look, there's going to be great opportunities on the other side of this bear market, and we just need to be really prepared. That's why we're starting to look at things that we want to know what to look for, that the market is changing. Now, the market is a leading indicator in itself. It looks 4 to 6 months ahead, and it will be reacting to things that we probably can't even see yet. So what are some of these things? One of the things that would be to look for is the NASDAQ, which was the first index to hit new lows and has been hit the hardest, should be the first index likely to recover in the economic cycle as we start a new growth cycle down the road. So the NASDAQ should start outperforming the S&P 500 index. And so if I just took some representatives and I took the QQQ, divided it by the SPY, you want to see this line going up, showing that the QQQs are outperforming. And you can see we're in a severe downtrend all of 2022. And even though there is, the line at the bottom in pink is showing, we actually are starting to see a tiny step forward where the NASDAQ is not making new lows. It's actually starting to stabilize, but there's all kinds of overhead resistance. But I would keep my eye on this type of chart. We want to see the NASDAQ start outperforming. Now, we are starting earnings for quarter number 2. I think this is a great time as a sentiment indicator to watch earnings reactions. And the way I would use this from a sentiment point of view is, number one, if growth stocks continue to go down on poor earnings reports, that tells me that the market is still discounting weak economic growth into the future. Okay, so if new lows are made in growth stocks on poor earnings reports, we probably haven't hit bottom. We might get a tell if growth stocks stop going down on bad earnings reports. It could be a clue, but not a buy signal, that maybe the worst is over for growth stocks. So think about that. The news is bad. The growth stock put out a terrible earnings report, but they stopped making new lows. That's because institutions are looking out and the market is looking out. That could be a clue that things might be going sideways and starting to set us up for a rally. Now, building your watch lists and staying engaged in the market is very, very important at this time. I would start making your watch list with gross names that did not make new lows when the index made a new low. So that's a great place to start. And I would also start to look at stocks, growth stocks that have good earnings and sales, and that usually relates to a new product, new service. And you also look at the estimates. What are the estimates for 2023? Is this growth stock projecting another strong year ahead despite the bear market? That would be something that would interest me. I'd prefer to have names on my watch list that are above the 50-day moving average, if possible. And I prefer that they're within 30 to 35% of the old highs. I've shared this chart before, but the whole concept of overhead resistance, when you have stocks that are off 50, 60, 70%, it's really difficult to get that stock to gradually move up the right side and form a base without this zone of all this overhead supply, which acts as resistance. What's important is to try and look for stocks that have come off their lows. They've made a 25% prior uptrend, and now they're starting to form a base. In a base, we'll talk about more things to look for in the base. So there are stocks, growth stocks right now that have come off the lows and made 20 to 25% moves, and some of them are going sideways right now, which is a great sign. But bases, are going to take 5, 6, 7, 8 weeks, 12 weeks. So we could still be away from a base building process. That could take months. On the right, if you have stocks, growth stocks that have only corrected 20 to 30%, you can see that a 20% move off the bottom gets that stock really close to its old highs. There's less resistance and a more likely chance that that stock could break out and be a successful breakout. So it's an important concept. The prior uptrend concept cannot be overlooked. It's important that the stock starts to show an uptrend and builds a base. So continuing on with this proper basing concept is the base needs to show signs of accumulation. So the proper base, the depth and length are important. We know the minimum for a 5-week base is 5 weeks. Cup with handles to be proper need to be 7 weeks. So what are these signs of accumulation you want to see in the base? Well, things I look for are, I want to see the daily and weekly price volatility contract. The daily ranges, the weekly ranges get tighter, which should become very obvious from the previous 6 months of action on this decline. You want to see some tight weekly closes in the base that shows institutions are starting to control the price of that stock. You'd like to see multiple up weeks in a row, particularly on the right side of the base. 3 to 5 up weeks in a row is a sign that institutions are accumulating shares. Gap ups on the right side of the base while you're still in the base are showing buying pressure in that base, which is a sign of accumulation. And simply looking at the weekly closes of the range near the top of the range are also a very, very positive sign. So those are things to look for. There are some stocks that are attempting to put in some of these qualities. I think maybe what we'll do in a future video, we'll start to look at these in a little more detail and why they're on my watch list, and maybe there's something that you want to consider as well. So thank you so much for joining me. Have a great Independence Day. There's my Twitter handle. Follow me on YouTube. Click the bell. Send me comments. I really appreciate it. And I'll see you soon on the next General Market Update.